Silver drops to $55. One chart explains the next move. Somewhere, right now, a trader is staring at a screen, watching a number he never thought he'd see again. $55. 6 months ago, silver touched $121. Today, it is less than half of that. But here is what nobody is telling you. There is one chart, just one, that has predicted every major move in silver for the last 50 years. And right now, that chart is flashing something almost nobody is watching. By the end of this video, you will see exactly what it says and exactly what happens next. Stay until the end, because this decision cannot be undone once the market moves. Welcome back to the channel, friend. This is John A.G. If you are new here, take a seat, pour yourself a cup of tea, and get comfortable, because what is about to be explained deserves your full attention. Now, before anything else, a small request. Not a demand, just a request, the way a neighbor might ask for a favor over the fence. If this channel has ever helped you understand money a little better, if it has ever helped you sleep a little easier about your savings, then please take 3 seconds and press that subscribe button. It costs nothing. It means everything. And one more thing. Tell us where you are watching from. Are you in Lahore, Karachi, Dubai, London, New York? Type it in the comments. Let this become a room full of people, not just a screen. Now, let us begin. Silver did something this week that surprised even the people who study it every day. It fell to $55. Not 55 as a headline number. 55 as a real, confirmed price, touched during trading, watched by millions of eyes around the world who own this metal, trade this metal, or simply hope to buy it one day. 6 months earlier, in January, silver stood at $121. It was near its highest point in modern history. People called it the trade of the decade. Analysts on television spoke about silver reaching $150, then $200. The mood was confident, almost too confident. Then, slowly, the price began to fall. Not all at once, not in a single dramatic crash that makes headlines for one day and disappears the next. It fell in stages, a drop here, a small recovery there. Then another drop, deeper than the last. Week after week, month after month, the number kept sliding down. By the time it reached $55, silver had lost more than half its value from the peak. For the average person watching from outside, this looks like disaster. It looks like the story is over. It looks like the people who bought silver near the top made a terrible mistake, and the people who are still holding it are fools for not selling. But history rarely moves in straight lines, and markets rarely tell the truth on the surface. Underneath this price collapse, there is a chart. A single technical chart that traders and analysts have used for decades to separate two very different situations that look almost identical on the surface. The first situation is called a capitulation bottom. This is the point where a decline finally ends, where the last frightened sellers give up, sell their positions in panic, and the market has no one left to sell. After this point, prices typically begin to rise again, often sharply. The second situation is called a mid-decline pause. This looks similar. Prices stop falling for a few days, there is a small bounce, people feel relieved. But this is not the end of the decline. It is only a rest stop before the price falls further, sometimes much further than before. The difference between these two situations is not something a person can feel emotionally. It is not about hope or fear. It is something that can be measured, studied, and read directly from the chart itself. And that is exactly what this video will walk through, step by step, without shortcuts, without hype, and without pretending to know the future with certainty that no honest analyst can claim. Right now, silver sits at a price level that connects directly to a moment 6 months in the past. In November of last year, before the big rally began, silver reached a high point near $54. That level became the launching pad for everything that followed. It was the floor that held, while the price climbed all the way to $121. Now, 6 months later, the price has fallen all the way back down to that exact same floor. This is not a coincidence. In financial markets, old support levels and old resistance levels tend to matter again when the price returns to them. It is one of the oldest and most tested principles in technical analysis, going back over a century. The question that matters now is simple to ask, but difficult to answer. Will this old floor hold the way it held before? Or will it break, opening the door to a much deeper decline than anyone currently expects? The businessman, the entrepreneur, the serious investor watching this cannot afford to guess. Guessing is expensive. What is needed instead is a framework, a disciplined way of reading the evidence that removes emotion from the decision entirely. That framework exists. It has existed for decades. And it is about to be applied, piece by piece, to exactly what is happening in the silver market today. To understand where silver is heading, one must first understand exactly how it fell this far. And the story is not simple. It is not just the price went down. It is a chain of events, one triggering the next, like dominoes falling across the world, each one connected to the other in ways most people never noticed as they happened. It began on January 30th. Just one day after silver touched its all-time high of $121, something happened behind the scenes that most casual investors never saw coming. The exchange that controls silver futures trading raised its margin requirements. This sounds technical, it sounds boring, but it is one of the most powerful tools in the entire financial system, and it has broken silver markets before. The same tool was used in 1980 when a group of billionaire brothers tried to corner the silver market and the price collapsed almost overnight. The same tool was used again in 2011 when silver neared $50 and then fell more than 30% in a single month. When margin requirements rise, traders who borrowed money to buy silver suddenly need more cash to hold their positions. Many cannot provide it, so they are forced to sell. Not because they want to, not because they believe silver is worth less, but because the system demands it. That single decision, made quietly in an office far from any mine or factory, triggered the first wave of selling. Silver fell from its peak toward $85 within days. But this was only the beginning. 1 month later, in February, a war escalated in the Middle East. Missiles were launched. Tensions rose in one of the most important oil regions on Earth. Oil prices surged past $100 a barrel. Here is where the story takes its first real twist. Most people assume war and chaos should make silver rise. Silver is often called a safe haven, a protection against uncertainty. But something different happened this time. Rising oil prices pushed inflation higher across the world, and when inflation rises, central banks, particularly the Federal Reserve in the United States, become far less willing to cut interest rates. The market had been expecting rate cuts throughout the year. Those expectations vanished almost overnight. This mattered enormously for silver, and here is why. Silver pays no interest. It sits quietly in a vault or a drawer, earning nothing on its own. When interest rates are high, investors can earn safe, guaranteed returns elsewhere, in bonds, in savings accounts, in treasury bills. Why hold a metal that pays nothing when cash itself is paying well? So even as war created fear in the world, it also created a force that worked directly against silver's price. The metal was caught between two opposing pressures, and for months it drifted sideways, absorbing the damage. Then, in early June, another twist arrived. A ceasefire proposal in the region collapsed. Hope for peace, which had been quietly building, disappeared. Around the same time, a jobs report in the United States showed the labor market was still strong, stronger than expected. This should have been good news for the economy. But for silver, it was another blow. A strong job market meant the Federal Reserve had even less reason to cut interest rates. And so the pressure that had been building for months finally broke through. Silver fell through $70, then $65, then $60. And finally, this week, it touched $55.70 before recovering slightly. Each step down was not random. Each step down had a cause, a reason, a chain of events connecting a decision in Washington to a missile launch overseas to a jobs report to a price on a screen watched by millions. This is the part most people miss when they look at a falling chart. They see only the number. They do not see the story behind it. They do not see that this decline was built by policy decisions and geopolitical events, forces that are temporary by nature, not permanent laws of the universe.
And if these forces are temporary, then the price movement they caused may be temporary as well. But knowing the cause of a decline is only the first step. The next step is far more difficult. It requires a framework to determine whether this particular decline has finished its work or whether it still has more damage left to do. There is a question every serious investor must learn to ask, and most never do. It is not, will the price go up or down? That question is guesswork dressed up as analysis. The real question is far more precise. What does the evidence actually show, right now, at this exact moment? To answer this, professional analysts rely on a framework built from decades of market history. It contains 4 elements, and when applied honestly, without bias, without hope, and without fear, it reveals something the headlines rarely explain. The first element is volume. When a true bottom forms in any market, it is usually accompanied by extreme selling volume, a final wave of panic where the last remaining holders give up entirely. This is the moment often called the point of maximum pain. It is loud, it is dramatic, it leaves almost no buyers left to disappoint. The second element is oversold conditions across multiple timeframes. Analysts study momentum indicators not just on daily charts, but on weekly and monthly charts as well. A genuine bottom tends to show exhaustion across all 3. A temporary pause tends to show exhaustion on the short-term chart only, while the longer-term picture remains untouched. The third element is structural support. Not just any support level, a major one. A level with historical weight, tested across years, sometimes decades. Minor support levels break easily. Major ones do not. The fourth element is sentiment. True capitulation arrives with despair. Headlines declaring the asset finished, analysts abandoning their price targets, ordinary people posting their losses publicly, swearing never to return. Now here comes the twist that changes everything. When this framework is applied to silver's current situation, the picture that emerges is not what most people expect. The volume this week was elevated, yes, but not extreme. Not the kind of volume seen in late January, when the first wave of forced selling tore through the market. This week's selling was heavy, but controlled. Not panic. Not surrender. The oversold readings tell an even more revealing story. On the daily chart, momentum indicators dropped deep into oversold territory, suggesting short-term exhaustion. But on the weekly chart, the reading was only moderately low. And on the monthly chart, the time frame that matters most for long-term direction, the indicator sat almost exactly in neutral territory. This is the twist most casual observers completely miss. A market only in the early or middle stages of a decline shows exactly this pattern. Short-term panic, but long-term calm. A market at its true final bottom usually shows exhaustion everywhere, on every time frame, all at once. The third element, structural support, tells a more complicated story. Silver is currently testing a support level from 6 months earlier, the point that launched its historic rally. This is meaningful, but it is not the same as testing a support level that is held for decades. There is a much larger, much older support level far below the current price, one tested across multiple economic cycles. Silver is nowhere near that level yet. And the fourth element, sentiment, is perhaps the most surprising of all. Yes, the headlines have turned negative. Yes, doubt has crept into public conversation. But true despair has not arrived. No major institution has declared silver finished. No respected analyst who once predicted triple-digit prices has reversed into predicting a collapse to $20 or $30. The fear is real, but it is not yet total. Put all 4 elements together, and a clear conclusion begins to form. One that will surprise many people watching this unfold from the outside. This is not yet a full capitulation bottom. It is something else, something in between. A deep,
painful correction happening inside a larger structure that has not yet been broken. The market is testing something important right now, testing whether the floor beneath this 6-month rally will hold or whether it will give way to something deeper. And that leaves the businessman, the entrepreneur, the careful investor with a critical decision ahead. Not a decision to make emotionally, not a decision based on fear or excitement. A decision that depends entirely on what happens next at this exact price level, the level being tested right now as this very moment unfolds. Every serious decision requires looking honestly at both outcomes, not just the one a person hopes for. And this is where the story reaches its most important turn. There are two paths ahead for silver, only two, and the difference between them comes down to forces far bigger than any single trader, any single company, or any single chart pattern. The first path is resolution. This is the scenario where the war driving oil prices higher begins to calm down. Diplomatic talks that have been quietly continuing behind closed doors reach some form of agreement. Oil prices ease, inflation pressure fades. And with that pressure gone, the Federal Reserve finally gains room to cut interest rates, something markets have been waiting for since the start of the year. If this path unfolds, everything changes for silver. The same force that made cash more attractive than metal begins to reverse. Interest rates fall. The appeal of earning safe returns in a bank account fades. And investors who abandoned silver during the decline begin returning, searching for protection against a weaker currency and lower returns elsewhere. Under this path, the support level currently being tested holds. The price does not fall much further. And what looks today like fear and panic will, in hindsight, look like an opportunity that only the patient and the informed were brave enough to take. But there is a second path, and it must be spoken about honestly, without softening it. If the conflict driving oil prices does not ease, if oil remains above $100 a barrel through the rest of the year, if inflation stays high and the Federal Reserve is forced to hold interest rates steady or even raise them further, then the pressure on silver does not disappear. It continues. Under this path, the support level currently being tested breaks. The price moves lower. $50 becomes the next stop. If conditions worsen further, $45 becomes possible. This would not be the end of silver as an asset, but it would mean the pain continues longer than most people are currently prepared for. Here is the twist that separates casual observers from serious analysts. Neither path is certain. Anyone claiming to know exactly which one will happen is not being honest. What can be said with confidence is this. The forces pushing silver downward right now are temporary in nature. Wars end, interest rate cycles turn, central bank policy shifts. These are not permanent laws of nature. They are decisions made by people under pressure, responding to changing conditions. What has not changed through all of this chaos is the ground beneath the price. The physical supply of silver remains tighter than it has been in years. Global demand for silver in solar panels, electric vehicles, and modern electronics continues rising, not falling. These forces did not disappear because the price fell. They are still there, quietly building pressure beneath the surface, waiting for the moment the monetary headwind finally clears. This is the real lesson behind the chart. A chart does not predict the future with certainty. No chart can do that. What a chart can do is show, with discipline and honesty, where the important lines are drawn, the lines that separate one outcome from another. Right now, that line sits just below the current price. Whether it holds or breaks over the coming weeks will determine which of the two paths silver takes. For the businessman studying this from the outside, the lesson extends far beyond silver itself. Markets rarely move in straight lines. Fear arrives before clarity. Panic often peaks not at the true bottom, but somewhere close to it, testing the resolve of everyone watching. The disciplined response is not to guess. It is not to act on emotion. It is to watch the evidence, understand the forces at play, and remain patient until the market itself reveals which path it has chosen. That moment is coming. It may arrive in days. It may take longer. But when it does, those who understood the full story, not just the headline, not just the fear, but the complete chain of cause and effect, will be the ones prepared to act with clarity, while everyone else is still reacting with panic. Let it be known where this was watched from and what was thought while watching it. The comment section remains open, and every response will be read.